Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Keith Weiner with me once again. Keith's been on the show a couple of times in the past. Keith is the founder of Monetary Metals. He is a leading authority in the areas of gold, money, and credit, and has made important contributions to the development of trading techniques and founded upon the analysis of bid-ask spreads. And he is the founder of Diamondware. It's a software company sold to Nortel 2008, and he currently serves as president of the Gold Standard Institute, USA. He earned his PhD from the New Austrian School of Economics. Welcome, Keith, and thanks for joining me again.
Thanks for having me.
You know, I would like to tell our listeners before we get started here that they can go to the Monetary Metals website. They can easily do that by going to J. Taylor Media, clicking on the banner. There's a couple of banners there at J. Taylor Media, also at miningstocks.com, and I believe there's one also at the Voice America Business Channel. Click there, and it will take you right through to some articles that Keith writes, and all the things that goes on there at Monetary Metals. And Keith frequently writes very insightful articles, and it's one of those articles that we want to talk to him about today. So, Keith, I picked up on your on a recent article that you wrote on December 8th titled "The End of an Epoch." What epoch are you talking about?
I guess, in a way, you can call it the modern monetary system, which people are now starting to call late-stage capitalism. Though, of course, it has nothing to do with capitalism. It's not capitalism. Yeah. But the way in which we finance things, the way in which we live on credit, borrowing to spend, and calling that, an increase in GDP, is not sustainable. And it's kind of funny in the world that, in a way, the left makes an observation that things aren't good and, kind of getting worse for an awful lot of people. But, the observation is correct. Of course, their diagnosis is that it's capitalism, and their prescription is, well, we need a wealth tax, which is just evil. The right is trying to head the left off the path, so the right denies the observation and says, everything's great. The economy's never been better. Look at how low unemployment is, and they point to other either concurrent indicators or even trailing indicators to prove their point, cherry pick some data, and say everything's wonderful. But I think, millions and millions and millions of people sense there's something wrong. There's something wrong in the world right now. And I see a big part of my work as trying to put my finger on precisely what it is that's wrong. And that's what I meant by the end of an epoch.
Right. Well, I've titled today's show, after reading your article, Euthanasia of Capitalism by the Federal Reserve Bank. I think that's sort of the bottom line of what your article concludes. But then what we want to get to is, how can we fix things? How can we make things better, if not for the world, at least for ourselves? And we want to get to that. But I want to start out here by just reading Keynes's a very famous quote from Keynes that you started your article out with. There is no subtler, no surer means of overturning the existing basis of society than to debauch the currency. The process engages all hidden forces of economic law on the side of destruction, and it does it in a manner which not one in a million is able to diagnose, end of quotes. So, as you pointed out in your article, most people believe that what Keynes was talking about there was inflation, that inflation was the destroyer of the economy, and we certainly have seen, certainly could be cases where inflation, even in the late 1970s, Michael Oliver, who was on with us in the first segment, thinks we're heading back to something like the late 1970s with a more of an inflationary situation. But that certainly was very destructive. And hyperinflationary Germany and a number of other places, certainly inflation is destructive. But I guess maybe what you're saying is that's the key to it, is the debauching of currency, which is more to do with interest rates, as I understand. Could you explain maybe why do you believe that Keynes had that in mind rather than inflation? And to what extent do you believe that he was right about that?
Yeah, so obviously people hear the word debauch the currency. They think the value of the currency is, one over the price level, so therefore it had to be inflation. But I think that 999,999 out of a million could recognize inflation. Everybody talks about it even today. And I'm just old enough to remember the late 1970s. And believe me, everybody was talking about it. Mm-hmm. I can distinctly recall every week you'd go to the grocery store and every item had a higher price.
Yeah.
And what the grocery stores used to do back then, of course, there wasn't barcodes and scanners. They had to put a sticker on each item.
Mm-hmm.
And what they used to do when they wanted to have a midweek price raise is they would put a new sticker over the old one.
Mm-hmm.
So people used to play games where, if it wasn't too well aligned, you could peel off. So the stickers were designed, they couldn't be peeled off, they would tear. And then I remember in my local town in New York, some idiots were lobbying for a law to make it illegal for grocery stores to re-sticker a price once it had already been marked.
Oh.
That was the 1970s. We are not in that environment today. That was an environment where they had very strong pricing power, and there's nothing as a consumer you could do about it. Mm-hmm. And so people used to hoard. My parents hoarded cans of tuna fish because you'd rather have a balance of tuna fish in the pantry bank than a balance of dollars in the bank. That is not our environment today. What is it that 1 in a million people can't recognize? Well, he said in another quote, he calls the rentier, which is basically the saver, the investor, a functionless parasite, in Keynes' opinion. And he calls for euthanasia, killing this functionless parasite by driving the interest rates to zero. And, of course, that's our world today. They're driving interest rates to zero. And in Europe, Switzerland, Japan, Scandinavia, it's beyond zero. It's actually negative. And I think I think he's actually smirking. Mm-hmm. He's very smug and sort of chuckling into himself at how terribly clever he was to say, here's we're going to do this, and nobody's going to get it. Why is nobody going to get it? Because the price of the bond, and because of arbitrage in modern markets, all other assets, the price of the asset is the inverse of the interest rate. You drive the interest rate down, you drive asset prices up. Mm-hmm. So what does that mean? Is people aren't thinking about the euthanasia of the rentier. They're thinking bull market. Mm-hmm. Who can possibly dislike a bull market? Mm-hmm. When people tout how strong the economy is, under this president, it's the conservatives touting it. Under Obama, it was the liberals touting it, but it's the same touting. The first thing they want to point to is the stock market's going up, and that's proof the economy is good. And I'm looking at this saying that's proof that driving the interest rate to zero is working, because that drives the asset prices to infinity. Everybody loves a bull market, but Keynes was right. If you drive it to zero, then you destroy not just the value. It's not a like a neutron bomb that destroys the currency and everything else, and all the people survive. You sort of you tear at the fabric of society itself, because now the savers can't save. There are very few people asking the question, what is somebody who's working for wages today supposed to do about saving for retirement? Mm-hmm. And then, there's two basic answers to that. One is they throw their arms up and say, well, the government's going to pay me whatever, Social Security. Good luck with that one. And then the other one is, I've seen this in a few surveys where people think that they're going to sue a doctor and get rich, or sue somebody. And, of course, neither of those are really going to work for whole generations of people who need to retire. And so I think Keynes was right. There's something very evil and very destructive about this. And we're still at the point where not 1 in a million can diagnose it.
Yeah. 1 in a million thinks as long as the stock market's going up, everything is cool. Everybody thinks that, basically. The 1 in a million. We have David Stockman on this show who sees it differently. Several of our guests do. But for the most part, I think you're right. And as long as the Dow makes it up every day, they're just fine with the way things are. But we certainly do have a level of consumer inflation now, though, too, don't we? We certainly. I would maintain that inflation is much higher than what the government pretends it is. Inflation, as defined by the CPI, they certainly are not seeing the inflation that's gone into the asset prices, into the financial assets anyway. But healthcare, education, those kind of things are certainly, you would agree that they're rising prices and a declining purchasing power of the American consumer, would you not?
So I make a distinction between monetary causes for rising prices versus non-monetary causes. I've written a whole bunch of articles about this, and I define the concept that I call useless ingredients. And so this is what regulators and taxing authorities, for that matter, too. So just look at gasoline in the state of California. So first of all, when people say the purchasing power of the dollar is going down, do you mean the purchasing power of the Los Angeles dollar or the purchasing power of the Yuma, Arizona dollar, 250 miles east of there? Because, of course, the price of gas would be at least $1 different. Mm-hmm. So, California, they do two things to gasoline. They mandate expensive additives, So they have this MTBE, and they have ethanol, and they have all these other things. And then they also add taxes. So was it a year ago now, they added another 25 cents per gallon gas tax. So at the time that they enact this, everybody is quite aware that the regulators or the taxinators, as I call them, have increased the price of gasoline. But a year later, that's forgotten, and then people talk about inflation as a general amorphous term. I say, look, you really got to look at useless ingredients that are forced to be added by government versus monetary forces. So if you look at raw commodities, the picture you see, some raw commodities are at or near multi-year, even multi-decade lows, and other raw commodities, may not be quite at their low, but I mean, the price of crude oil is nowhere near its high. For example, I wrote an article, I think it was a couple of years ago, saying I had bought a pair of Levi's jeans in 1983, Levi's 501 jeans in 1983 for $50. I distinctly recall that because at that time, for me, $50 was like saving up a lot of my allowance. I was in high school at the time. And a couple of years ago, when I bought a pair of Levi's 501 jeans, they were $45. And so I just kind of had to look at this and say, if we really had the rampant inflation that everybody's talking about, I mean, you can quibble and say they're made in China and maybe Levi's cheapened it. Well, I couldn't really see how they cheapened it. To me, it felt like the same product, but you can quibble this and that and the other thing. But, 30 some odd years of relentless skyrocketing inflation, if that really were the case, there's no way that it would be $5 cheaper than it had been all those years earlier. It would be $500 and not, $45. And so I think, and of course, use the example of healthcare, the other one being higher education, the cost of a university degree. And those are the areas in which the government has interfered and distorted the worst. So if you take a look, you can compare healthcare for necessary, correcting disease type healthcare versus elective things like LASIK eye surgery, or for that matter, veterinary care for your pet. And there's a huge contrast. The cost of LASIK has been coming down, not up. And the cost of veterinary care is, suffering the same problem that every other industry has, which is they have no pricing power. Volumes are falling, and the only way to get, more volume is to either cut your price or offer 0% financing. And so I think those are non-monetary forces that are driving up certainly education and healthcare, but in general, when prices are rising, that's what it is.
Why do you think Keith, why do you think we've lost pricing power now as opposed to the 70s? Why is that?
So in a rising interest rate environment, whoever has got a factory that manufactures, whether it's pencils or cars or clothing or whatever, they've got their factory financed at a certain interest rate, then the interest rate goes up. And so nobody has any incentive to get into that business. The cost of capital is higher. The only incentive to get into that business is if the profit margins widen. And so in a rising interest rate, rising price environment, prices go up sufficiently, and then maybe somebody dips their toes in the water. But in a falling interest rate environment, which is what we've had since 1981, in a falling interest rate environment, every manufacturer is thinking, who's considering, should I borrow money and open up, whether it's a hamburger stand or whether it's a factory that manufactures, widgets, they look at it and say, okay, do I want to borrow at 6%? Maybe not. Then the market comes back and says, how about 5? How about 4? How about 3? And they keep making capital cheaper and cheaper and cheaper until they lure the next guy in, the next marginal producer is lured in. And so not only he's lured in only because the cost of capital went down, and now he is able to either have a lower payment financing the same factory as his competitor does, or he can build something bigger that has higher capacity and spend more capital cost on it, but then his monthly payment is the same. And so the net result is he's putting the squeeze on the margins of his competitors. Then they lower the interest rate again. His old competitor is now out. New competitor puts the squeeze on him, and then they lower the interest rate again, and that's our world. So nobody, just as soon as you think you can make a little bit of margin, they lower the interest rate and you have a new competitor. So it's a very destructive environment, but it's doing it in a way that not 1 in a million can diagnose it. Because, of course, not only are the investors happy that their assets are skyrocketing, the consumers are happy that prices are soft or even falling. Go to a shopping mall right now. It's not unusual to see huge sales. This is before Christmas. I mean, it used to be when the world was quote unquote normal that, you didn't see sales until, the stores reopened after Christmas.
But Keith, we're on this sort of this massive spiraling down of interest rates, negative in a good part of the world. It would seem as though they're headed to the United States as well. And Alistair McLeod, who's a guest on this show sometimes, was making the point that if the dollar as the world's reserve currency goes negative, it's different than if the euro or the yen or the others go negative, because everything is denominated in dollars. And so everything has a time preference, which I'm sure as an Austrian economist you probably agree with.
Yes, absolutely.
That his point is that if the dollar goes negative, and he says that gold, for example, has a time preference of maybe 2% or 2.5%, somewhere in that range, and that doesn't change. So in part, what you're doing now, your program is allowing people to lease gold. I just participated in a very small way in a deal that you put together, and I think we're getting 2.25%. You can't, and we'll get paid back in gold, and we're not lending gold; it's a lease. So we're not taking the same risk as if we put our money in the bank, because there we're not the owners of that money anymore. We're a lender to the bank, an unsecured lender at that. But do you see, Alistair's point is that he believes that the dollar could be in some real trouble if we continue to go negative, because people won't have any option but to trade the dollars for stuff. And if the dollars go down dramatically, won't that, in terms of if prices are measured in dollars, if the dollar loses if confidence is lost in the dollar, won't that mean that prices will go up as denominated in the dollar?
So first I wanted to say it's very interesting, his point about time preference, and in gold you can't manipulate the interest rate. In a certain sense, monetary metals is conducting an experiment in the market about such things. And, we've done a variety of deals that have ranged, this is net to the investor, ranged on the low end from 2%, so there's Alistair's number, up to 4.5% on the high end. And, we'll continue to run the experiment and see where it is. I don't want to bias it by opining on that. But there definitely is a time preference, and if the interest rate goes below that, in gold, people will just simply pull their gold coin out of the market and say, well, you can't have it then. It only comes in for interest. But I also agree that if the interest rate in the dollar goes negative, that is extremely dangerous. I do think, in fact, I think it's inevitable that it will go negative, but it will come to the dollar last. That is, after all the other currencies have failed, the dollar is the last one to fail, because it's the reserve. And what reserve means is all the other currencies are dollar derivatives. There is no way for any other currency to survive the destruction of the dollar. If any had survived that long, which I don't think is likely anyway, then it would be wiped out. It would be like being a little life raft bolted to the side of an aircraft carrier. When the carrier sinks, that life raft isn't going to survive. That is extremely dangerous, because when the interest rate is manipulated negative, it's essentially it's like a central planner forcing a wrong price. So we all know what happens if, in Venezuela, they say the price of gasoline is 20 cents a gallon. And then, you get overconsumption of gasoline, and then eventually, the state, gas industry fails because they can't, losing money at that price. Well, if you misprice credit, then what happens is, it's as if you're saying to people that your time preference is going to be negative. But that's like King Canute ordering the tide back. Yeah. It doesn't work that way. The legislator, the government, can never change natural law. And so what you get is some very perverse behaviors. There will be a loss of confidence in the dollar at the end, which is certainly not occurring right now at the moment. I really want to emphasize that. And when it occurs at the end, people are going to buy things. And of course, the best thing to buy in that environment is gold. I mean, nobody really wants, Mises talks about ladies' shoes and frying pans and stuff. That's what you're going to buy if you can't buy gold. But really, it's a rush for gold, because that's the best thing to own, in that environment. And that's going to be an enormously destructive cataclysmic event. I think it's going to be like 476 AD. This is not 1979. It's not 1929. It's the end. And
what was that date? What was that date again?
476 AD is when Rome collapsed.
Yeah.
So the population of Rome in the city was over 1 million people before that, and afterwards it was 6,000 or 8,000. So we assume that a few refugees escaped to a farm somewhere remotely, but most of those people probably died.
Well, Keith, I don't know that we like to hear that sort of thing, and I'm not sure what you can tell us to cheer us up after that. I might have some people that throw in the towel and jump off the bridge. We don't want that.
My point of this is, and I personally made a decision not to try to prep for that eventuality, but to try to oppose it. Mm-hmm. And the way out of this, there's no way out as long as we cling to the irredeemable dollar. The way out of this is to return to a gold standard, and that's the whole point of what I'm doing ultimately. Right. Why I'm doing it. If this was a normal world, I wouldn't be in the gold business. I was a software guy. I sold my software company. Another software company.
Yeah, a lot of other things you can do.
There is hope.
Yeah,
there is hope, and I'm pursuing that hope right now.
Okay, a lot of other things you could be doing. So at least for the individual, for those of us individuals, we should start thinking in that way, and then maybe collectively things will get better. We can hope and pray for that. But Keith, I want to thank you very much. We're out of time. I guess the best thing to tell people to keep up with your writing, you write at least once a week, don't you? If you go to monetarymetals.com, right?
Monetary-metals.com, yes, I write at least once a week.
Excellent. Very good. Well, thank you so much for being with us, Keith, and we'll look to have you back again sometime in the not-too-distant future.